In this video we are going to talk about the power of dividend investing. So before starting this video, please like this video and subscribe to this channel for our future updates. Almost all investors are aware of the power of compound interest, and dividends function in a similar way, especially when dividends are reinvested back into the business. Thus, a $10,000 investment in Coca-Cola in 1962 would have generated more than $2 million by 2012, which is 50 years after the first investment was made. Dividends are reinvested to purchase more shares, which in turn generates even more dividends, and so on. The following are some of the benefits of dividend investing. Companies have the ability to boost dividends over time. For example, Procter & Gamble has increased its dividend every year for the past 60 years. Companies are unable to deceive shareholders by declaring dividends. A corporation either declares a dividend or does not. Dividends act as a hedge against inflation. 1912 to the present, dividends have climbed by 4.2% and inflation has increased by 3.3%. Dividends add intrinsic value to an investment since they produce cash flow for the investor. As a result, dividends can assist in reducing volatility. This is because the dividend yield grows as the market price of a company declines, making the stock more appealing to investors. Dividends are an important method for firms to give back to their shareholders, and dividend stocks may be a powerful component of an investor's portfolio if they are held in the correct circumstances. Dividends are important for investors for a variety of reasons, the most important of which are that they substantially increase stock investing profits, provide an additional metric for fundamental analysis, reduce overall portfolio risk, provide tax benefits, and help to maintain the purchasing power of capital. Number 1. Growth and expansion of profits. One of the most significant advantages of investing in dividend-paying firms is that payouts have a tendency to grow consistently over time. Historically, dividend-paying corporations with a long track record of growth have increased their dividend distributions year after year. There are a handful of dividend aristocrats, or corporations that have grown their dividend distributions year after year for more than 25 years in a row, in the financial markets. The compounded annual growth rate, CAGR, of the total return for S&P Global Dividend Aristocrats for the past 10 years, as of July 17, 2021, has been 2.23%. Another fundamental concept in stock market investing is the concept of market risk, which refers to the inherent risk associated with every equity investment. Stocks may rise or fall in value, and there is no assurance that their value will increase. Dividend stocks provide at least a partial return on investment that is virtually guaranteed, even if investing in dividend-paying companies does not always result in profits. It is extremely rare for dividend-paying corporations to ever cease paying dividends. In fact, the majority of these companies have seen their dividend payments improve in value over time. Many investors are unaware of the significant impact dividends have on the performance of the stock market. In the period 1980 to 2019, dividends accounted for 75% of the total return on the S&P 500. This suggests that the inclusion of dividend payments accounted for the vast majority of the gains gained by stock investors in terms of returns on investment as compared to the returns they would have realized if dividend payments had not been included. Furthermore, in current low-interest rate environment, the dividend yield offered by dividend-paying corporations is far higher than the rates available to investors in most fixed-income products, such as government bonds, which is a positive development. Number 2. Dividends are helpful in equity evaluation. In the same way that the impact of dividends on total return on investment, or ROI, is sometimes forgotten by investors, so is the fact that dividends can be a useful point of comparison when evaluating stocks and making stock selection decisions. The usage of dividends in the appraisal of stocks is frequently a more trustworthy equity evaluation tool than many other more commonly used measures such as the price-to-earnings ratio, or PE ratio, for example. The majority of financial measures utilized by analysts and investors in stock analysis are based on information derived from financial statements of corporations. The possible problem with judging stocks simply on the basis of a company's financial statements is that corporations can, and unfortunately sometimes do, falsify their financial statements in order to improve their appearance to investors by employing misleading accounting techniques. Dividends, on the other hand, are a reliable indicator of whether or not a firm is functioning successfully. In a nutshell, a company's cash flow must be positive in order to make a dividend payment. Dividend payout ratios provide investors with a solid reference point for performing basic fundamental analysis on the strength of a company's present and historical dividend payout ratios. When a company pays dividends, it is able to provide ongoing year-to-year signals of its development and profitability, regardless of whether or not the firm's stock price rises or falls over the course of a year. Companies that continuously increase their dividend payments over time are more likely to be profitable, and less likely to have their fundamental financial health jeopardized by temporary market or economic downturns. Using dividends to evaluate a company has an additional advantage in that, because dividends are only changed once a year, they provide a considerably more stable point of comparison than indicators that are vulnerable to the daily variations in stock price. Number 3. Reducing risk and volatility. Dividends are a significant element in lowering the overall risk and volatility of a portfolio. Dividend payments, in terms of risk mitigation, help to offset any losses that may result from a drop in the value of a company's stock. However, the value of dividends in terms of risk reduction extends beyond this fundamental reality. Historically, studies have found that dividend-paying equities outperform non-dividend-paying firms during down market periods. When the market as a whole is down, stocks normally suffer a similar decrease in value across the board. However, dividend-paying companies often suffer a substantially smaller decline in value than non-dividend-paying equities. Recently, however, there has been a reversal in this trend. Over the last 20 years, there have been 3 bear markets, with dividend stocks outperforming during the first 2, but dividend-paying stocks underperforming during the most recent, which occurred during the coronavirus pandemic. Discount stocks outperforming. Conversely, dividend-paying companies performed better than their non-dividend counterparts during the other 2 bear markets, namely the tech bubble implosion of early 2000s and the financial crisis. Furthermore, dividend stocks have proven to be less volatile than other types of equities. From 1990 to 2018, according to a Merrill Lynch study, firms with a history of continuously increasing dividends beat non-dividend paying stocks in terms of total return while experiencing less volatility. Number 4. Dividends provide tax benefits. Because of the way dividends are regarded in terms of taxes, dividends are a relatively tax-efficient method of generating revenue. Qualified dividends are taxed at rates that are significantly lower than the rates applied to ordinary income. Qualified dividends are taxed at a rate of only 20% for persons whose ordinary income tax rate is in the highest bracket, 35% or 37%, according to the Internal Revenue Service. Furthermore, qualifying dividends are taxed at a rate of 15% for those whose ordinary income tax rate is between 12% and 35%, while qualified dividends are exempt from taxation for those in the 10% and 12% tax brackets, respectively. Number 5. Dividends help to maintain the purchasing power of capital. Aside from that, dividends can also assist investors in another area that they may overlook: the impact of inflation on investment returns. Prior to realizing any actual net gain from a financial investment, the investor must first ensure that the investment generates a sufficient return to compensate for the loss of purchasing power that arises from inflation. A stock improves in value by 3% over the course of a year, but inflation is running at 4%, the investor has really experienced a 1% loss in terms of the purchasing power of his or her investment money. For example, if the same company that has gained in value by 3% over the past year also has a dividend yield of 3%, the investment has successfully generated a profit that has outpaced inflation and has resulted in a real increase in purchasing power for the investor. The good news for dividend-paying company investors is that many dividend yields outperform inflation, which is a welcome development. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.